not only the Forex market, not only the stock market, every market, like eggs, bread, oil, whatever. When demand is greater than supply, which means that people buy that stuff, people want that stuff, prices are automatically gonna rise. And when supply is greater than demand, which means that people are either selling or they refrain from buying because price is too expensive, then price will automatically fall, right? And this happens in every market. Take, for example, an ice cream of Ben & Jerry's. Here it usually costs like 6 euros. Nobody buys this on 6 euros. So what usually the supermarket does is they run sales, right? Because they have a lot of supply of Ben & Jerry's, but there is no demand at this price. So what they do is they decrease the price in order to increase demand. So then people go in, a lot of demand, they buy all the ice cream, but then they don't just want to keep throwing away that ice cream at this high demand. So again, prices rise. And then this cycle keeps repeating, right? That was a little bit of a funny example, but hopefully you get the point. On a price chart, supply and demand is usually interpreted as oversold. So you either have supply running out and demand coming in, or overbought, demand running out and supply coming in. And our task as traders is to identify at what zones price will be oversold so we can buy it, or overbought in order to sell it. Again, going back to the previous lesson, this is simply buying low and selling high. And how we do this? Well, we utilize supply and demand zones, once again combined with market structure. And there are a lot of theories. So we have the Wyckoff price cycle, right? The market accumulating while it's being oversold. So right now demand is starting to get in. It pushes up. Then we have distribution. The market is overbought, and then supply is greater than demand. So the market starts going down. And what you're usually going to see is, as I told you, the market moves in cycles. You're going to have up, you're going to have down, you're going to have up, you're going to have down, right? And this is again market structure, but also within the foundation of market structure, supply and demand is also right there, right? And then of course you have this here. This is more like, again, I think it's also a Wyckoff schematic. This more takes into account also market structure. So what we have right here is, again, the market accumulating. It's starting pushing up, pushing up, pushing up, getting into that overbought state. It starts to distribute, then it starts pushing down, pushing down, pushing down. And pretty much this is market structure. So there are numerous ways to study supply and demand, but I really want you to understand like really the foundation of it. So how and why do supply and demand zones form? So we're going to get a little bit more technical right there. And I want to always walk you through the psychology behind. Trading thousands of millions of lots, and they probably don't even utilize lot sizes, right? They're probably trading just cash. I don't know. Nobody knows. So whoever pretends to know how the BFIs or how the institutions are trading, you probably don't, right? Very important to understand also is that trading is a zero-sum game. So you have a positive sum game and you have a zero-sum game. A zero-sum game is that when somebody wins, someone else has to lose. In order for someone then to sell one lot of your USD, someone else has to buy one lot of your USD. And some of those people, right, one of those people is gonna lose. Well, a positive sum game is, for example, a service. So if I give you my mentorship, you pay me money, which is my reward, and then I give you the mentorship, which is your reward. So it's a win-win situation, right? There is growth. It's a positive sum game. But a zero-sum game, one person is gonna win, the other person is gonna lose. So in order for someone to sell one lot, someone else has to buy one lot in order to meet the other side. And usually we do not need to worry about the execution of our trades and about liquidity because, yeah, we can always go to our broker and put as many lots as we want, but those BFIs, they do worry about it. So let me give you an example. Imagine that bank X, I don't know, Barclays, JP Morgan, they want to place 1 million lot long on Euro USD. Respectively, what are they going to need is 1 million lots shorts at the same time so their order can get executed. Because if they want to buy one lot, they need to buy it from somebody, right? So if they want to buy 1 million lots, somebody else has to sell them 1 million lots. And usually that seller of 1 million lots, it's not just going to be one person. It is us. It is the whole market. So they need to actually find and generate those 1 million lots of shorts. How do they do this? Well, they trick traders into selling and buying the market, and they generate the patterns we all know. Double tops, triple tops, flags, trend lines, head and shoulders, triangles, pennants, all of this stuff. And they make it look really good so that a lot of people start buying and selling, and they build liquidity in the market. However, what's the bad thing is that after those formations are ready and people are in, then banks will usually launch a big fake position. And what this fake position does, it stops out all the traders. it is very important to understand that when you get a stop loss, your order automatically turns into the opposite order. So a stop loss on a buy position, so if you take a long trade right now and you get a stop loss, then immediately after hitting stop loss, you turn into a sell. You pretty much sold what you bought, right? So if enough people are long, for example, and all of those people are stopped out, they pretty much offer those sells to the bank who wants to buy, right? And this is how banks get their liquidity. However, what is also important to note is that when they launch this fake move to stop out the traders, they also run into some drawdown, because in order for them to launch this fake move, they still have to enter the market. And this is usually why they will come back to that same place they launched their fake orders, mitigate those losses at break even, and then launch again with their own liquidity. So this is really theoretical. I want to jump into an example right now and actually walk you through how that happens. But hopefully so far you're getting the point. Say at this precise moment, a bank wants to buy 1 million lots, exactly what was said before. What do they need in order to buy those 1 million lots? They need 1 million sells, right? And they need 1 million lots to be on the sell side in order for them to put their 1 million lots on the buy side. So what they start doing is they start generating the patterns, right? They make a double top. What is right there? A lot of sellers are entering, right? So what do they need? They need sellers. Here we have a double bottom. What does this make traders do? It makes them go long, right? So very good. They go long right now. What is below the double bottom is their stop losses. And if a buy gets a stop loss, what does it turn into? A sell order. So what they're going to be doing is they're going to be accumulating price, doing some math stuff. And then all of a sudden you get this very huge momentous move below or above, respectively, in an opposite example, that pattern, right? And this is what I call the fake move. And in this lesson, we're going to be seeing the fake move drawn with this red kind of rectangle, right? And if all the stop losses right now of the buyers are taking in, they turn into sell orders. And also what happens is that there are people that are looking to take the breakout. So for a lot of people, this is a structure break. They have their sell stop below, right? So people are entering shorts as the market breaks. What do the bank need? They need shorts, right? Then the market gives you a little bit of a pullback. A lot of people start entering short from here. Why? Because it's a lower high. What do the banks need? They still need shorts. They're still putting in their 1 minute lots, right? And then what suddenly happens is the market expands massively. So after the bank actually got their 1 million sales, they launch their buys. And they might not launch all of the buys at the same time. So maybe they just launch like 500K lots right there. Right? But what I want you to pay attention to right now is what I told you about this, if I just delete all of this fake position right here. So in order for them to make this fake position, they need to sell, right? So